Hello guys. How are you guys doing? It's been a while. Today we are going to be talking about entry models, and I'm just going to show you. One thing with me is I like to go straight to the point, so I'm just going to show you the way I take my trades. Then I'm going to show you the types of entry models. The types of entry models. So as we all know, I trade mostly ICT or let's say SMC, and although sometimes I combine with the knowledge of supply and demand and the knowledge of um, trend line, all those things are incorporated into um, my trading strategy. So, for those that want to know the way I trade, sometimes or most times, I just look for a high to be created. Then I look for a low as well, a high, an external range high, and external range low. Then I wait to see what the market does. And mostly the market does something like this, creates a new um, an internal range liquidity and goes to the upside to break structure. So when I see something like this, I just start preparing my gun for snipers. So when I prepare my gun after seeing this break of structure using this leg in which it is known as the internal range, what I do is I just wait for the market to still come back to take this low, this internal range low. After it takes it out, I just look for probably another block over here or a fair value gap over here. Then tab into this fair value gap or other block, then target this high to the upside. So this is practically my entry model. I don't do more than this. I don't look for anything more than this. This is the practical example of how I trade. This is just how I trade. So this is what I refer to as sorry, I'm coming. This is I'm coming. This act is what I refer to as inducement. This is what I refer to as inducement, and I'm going to be identifying it. I'm going to identify it with a dot. So when you see an internal range low, if you haven't watched my video on internal and external range liquidity, do well to check it out in my YouTube channel. Then when you see something like this, I just know that okay, this is my inducement. This is going to be induced. This low is going to be induced because it's an internal range liquidity, so it is going to be induced. So after it has been induced by the market, then the market um, taps into either an order block or a fair value gap over here and jump to the upside. And make sure before you are taking trades like this, make sure there is a break of structure, a very valid break of structure with the body and not with the body of the candle and not with the wick. Whenever I see the market takes out a high with a wick, I consider that break an invalid break of structure until the market takes out this place with a body, the body of a candle, the full body of a candle. Then that's when I'll consider it to be a very valid break of structure. So this is just practically how I trade. This is just practically how I trade. So when I just tab into this place, I just target this high. Just tab into this place and target this high. As simple as that. As simple as ABCD. I'm sorry guys, I'm coming. Mm. So just look for a way to target the high. I don't know what's wrong with my. So yeah, guys, yeah. Um, this is it. So I just target this high, and I don't want to be greedy. It's very important for you guys to set a very realistic target. A very realistic target is very important when you are a trader and you want to pack all the money in the market. Then that's where the problem comes in. That's where greed comes in. So just make sure you are disciplined, and you just when you just get a little that you want, just go out of the market and wait for another opportunity to go inside the market again. So yeah, you always make money as far as you can easily identify these things I told you. You can easily make money in the market. So okay, let's talk about types of entry model. Since you've seen the way I take my trades, what I do is, let's go to let's the next thing we're going to be doing is we're going to be seeing the types of entry model. So there's what we call a continuation um, entry model, and a continuation entry model in the sense that when the market is buying, you buy, and when the market is selling, you sell. So there's a continuation model, and there is a reversal model. So when the market is buying, you sell, and when the market is selling, you buy. That's what it means by reversal, or sometimes they call it counter trend. So you can counter trend, you can trade trade according to the trend, and trade against the trend all together. So yes, so this is what we call a continuation trade. So a continuation trade, as I said in my previous example, I said that just what I practically look at is a new high created, then there's like just look for a displacement to the upside, breaking structure. Then I'm waiting for the market to still come down and retrace a little bit to create a new internal range low. So after, you just wait and see whether the market creates a new internal range low. After that's created a new internal range liquidity, something like this. It might be if you haven't watched my video on liquidity, just make sure you watch it so that you understand more on liquidity. In your internal range liquidity, there are different types of internal range liquidity. We have the trend line liquidity, we have equal highs, equal lows, and all those things. So just make sure you go watch it first so that you understand it proper. So after you've seen something like this, just make sure you expect the market to take it out and tap into your order block or your fair value gap. After you've seen something like this, just prepare your lot sizes and make sure you hit the market, and make sure you treat the market responsibly. Just because you know that this is a very nice entry model doesn't make you to go out of your plan or go aggressively, because the market may just decide to take out this range liquidity and refuse to break this high, and you get, so the rest is history. So I'm going to show you the I've already spoke about the manipulations in the market and how liquidity have been taken out in my previous video liquidity video, so go and watch it. So when the market is trending upwards, just make sure you wait for it to have a impulsive move to the upside, to break structure and go down, and refuse to take out the low, then break another structure. After you've seen something like this, just make sure you start taking your trade. Make sure you put your limit over here, then your stop loss below the previous low, and take your trades. This is just a very easy way of taking trades, a very easy entry model of taking trade. I don't want to confuse you guys a lot. I don't want to give you a very complicated entry model. I just want you guys to understand this entry model is just the same thing as this one, just the same thing as this one I just spoke about the first time. So just make sure you see a high and it goes to the downside and refuse to break the low, then break structure to the upside, then comes down to take out the previous low. Then you just prepare your entry over here and take your entry, your sharp entry to the upside. So yes, as you've seen a continuation trade, let me just label it as continuation. A continuation. So a continuation trade. Let's look at what a reversal trade looks like. So let's look at what a reversal trade looks like. A reversal trade is, as I said, when the market is trending upwards and you are expected to take your trades to the upside, to the downside. So when it's trending upwards, trending upwards, trending upwards, trending upwards, trending upwards. When the market fails, when the market breaks structure to the upside and goes down to break structure and goes up again and fails to break structure to the upside, it's expected for you guys to prepare and just okay, what I look out when I'm trading reversals or change of character is I make sure I wait to see the high not taken out. Then the first thing you look at is the first thing you look at on reversal trees is you look out for the this word do you look out for the internal range liquidity to be taken out. After internal range liquidity has been taken out, something like this, then you calm down and wait to see if the institutional order flow or your high range, your swing high will be taken out. Just wait and see whether your swing high will be taken out, and obviously it's very much possible for your swing high to be taken out. You get my point? So it's very possible for your swing high to be taken out. Then after it's been taken out, the market may decide to break structure to the downside. Then you can now look for an inducement. After this break of structure, you look for an inducement. What I say is I always tell you guys that if an inducement doesn't have a break of structure, then it's not a valid inducement. An inducement needs to break structure first before you can consider it to be a valid inducement. So after it has created, this lake has created an inducement and it has broken structure, then you just make sure you look for another block over here or a fair value gap over here. Tap into when the market comes and taps into that other block or fair value gap, then you target the previous low to the downside. This is a very easy trade to take. But you need to be very careful. In terms of taking reversals. When you are taking reversals like this, you need to be very careful because the market may just decide to take you unaware. So let me mark out something for you guys to understand. Firstly, what you need to look out for is the fail to break in the swing high and internal range liquidity gets taken out. So make sure, let's see something, I'm coming. Make sure your internal range liquidity is taken out. For instance, now, okay, we are trending upwards. It breaks structure, again, break structure again to the upside, break structure again to the upside. So it's trending upwards. This is what we call uptrend, break structure. Then the market comes down and fails to break this high. When you see the market fails to break this high, you mark it. After you mark it, make sure you wait and see that the market breaks this previous low. Make sure it breaks this previous low. I repeat, make sure the market breaks this previous low before you consider this as an inducement. Consider this high as an inducement. Then after it has broken this structure, then what you are going to do is you are going to mark this place, this high, mark this high, an order block over here. There should be an order block and a fair value gap to make sure you have an additional confluence in taking something like this, taking a trade like this. So make sure there is an additional confluence for you to be taking trades like this. If you don't see any fair value gap or an order block over here or anything that validates your entry, do not enter. So when it taps into this, it's expected that it breaks structure again to the downside and keep on trending downwards. So this is just practically how the entry model works. This is how reversal works. So this is our continuation model, this is our reversal, so I hope you guys have understood whatever I've said. If you don't understand, feel free to drop your questions down below and in the class as well. So if you haven't joined my Telegram group, make sure you join my Telegram group. I'm soon going to start dropping free signals as well, so do well to stick around. So thank you guys for watching, and I'll see you in my next video. Peace out.